Look, thanks for giving me the chance to come down and visit with you all today. I was thinking about this, our presentation. I was coming down on the train, and I was very mindful of the fact that at Wimbledon there was this match of historic proportions. In fact, today it went into the third day and the 11th hour before this Frenchman finally succumbed. And I was thinking myself, as I was thinking about that match, when will this ever end? Well, I don't want anybody out there to think that about my speech, so I will try to go through this relatively quickly. And I know that you deal with a lot of issues of significance. This one seems to be a little mundane, you know, the stewardship of financial assets, mundane but important, and how you steward these investment assets during this third millennium. This millennium itself is only 10 years old, and has gone through periods of excessive glee and then dismal gloom, and that was just last week. We're now 15 months from the market bottom, and we're somewhere along the path of recovery. And for those of us with financial assets to deploy, there is no sidelines, there is no timeout. And we have a continual imperative to keep at it, to watch for it, and to do it as well as we can. And what I was asked to talk about was a little bit on the market and a little bit on the economy, the implications on investment management, and then a pathway on how collaboration might result in a better outcome. And mindful of the fact that I actually listened at lunch, we'll get through the first two things, and maybe we'll get a little joy at the end. So first, a couple observations on the benefits of collaboration. And this is the pain part that we'll get to the joy later. That obviously is a snapshot of the market over the last couple of years. The market environment remains incredibly complex and uncertain. Equities have rallied off the bottom, but have rallied too far too fast, and we are now dealing with the aftermath. The same is true in the fixed income markets, which have also rallied off the bottom, and have now have reached a point where they offer cash returns to investors that are barely worth the risks that we take. The hedge funds, which as a category have done better, show extraordinary volatility. It's hard to find the best managers, and when you find them, they're hard to access. Private equity and other asset classes has historically been a source of excess returns, but now it's having a hard time finding liquidity. Real estate itself has gone through excruciating retrenchment. It seems to be bottoming. But all in all, when you add those five factors together, it is an extremely challenging market. And that's because we have an extremely challenging economy. I'm not saying anything new to anyone around this crowd, but I think all of us have looked at the financial state of most industrialized countries, and you see the impact of this prolonged period of living well beyond our means, where you have large debt levels and continuing and large public sector deficits. Interesting enough, the world seems turned upside down as the emerging markets around the world, India and China, are actually demonstrating more financial health than we have ourselves. But as we all know, the return is quite new, and the history of financial stewardship in those markets is not exactly something that has a long history. Corporate cost reductions have fueled earnings growth, but it's tough to grow revenues during periods of contraction. And many argue that the massive central government intervention was important, but it's really hard to extract from. So what do we have as this opening part before we get to the joy part is a difficult market and a challenging economy, which brings me up to the real high point, which is 2008. Anybody remember 2008? I mean, some of us thought the world was coming to an end. I suppose that's really not the best metaphor, and thank goodness it didn't happen. But 2008 is an incredibly painful memory. Most of us had portfolios. Many saw portfolios have this abysmal decline in value. Everything seemed to be correlated. Everything seemed to be going down. Many institutions lost years of fundraising. Many worried about the safety of their custodians. During this period, it sort of capped off an impossible year with terrible scandals. Everybody remembers Bernie Madoff. That wasn't the only one. In short, as we add all these things together, we have a challenging market, a difficult economy, and 2008 is this painful memory. So we're at one of those junctures in times where we can look forward and know that we'll end up in a better place. But today the question is how do we optimize our chances to actually do that? So I have some thoughts that I thought that we would share based on our observations around 2008. Learn from it and set a thoughtful strategy around your portfolio that spreads assets across two dimensions. Everybody knows the value of asset class diversification, spread equities and fixed income, alternatives, private equity, commodities, real assets. The diversification is designed to provide balance among non-correlated asset classes, designed to preserve capital and diversify risk. But there's a second dimension, and that is across time. One of the big lessons of 2008 was the unfortunate realization that assets had to be sold at exactly the wrong time. Because the planning that went into the allocation did not appropriately plan for the issues of asset allocation spread and then a timeline. So the second issue is making sure that we have these two allocations balanced. Classically, what this means for us now is thinking across time in three dimensions: cash you currently need, cash you need as the interim cushion, and then what you're going to do to provide for your long-term aspirations. But as we have seen now, cash protects, and in today's environment yields nothing. And reaching for long-dated assets can result in excessive exposure. So sophisticated investors today, after 2008, recognizing the dual challenges, plan across these two dimensions. Second observation is average should not be acceptable. Average performance is never enough, and 2008 is a painful reminder of what can happen with bad strategy and bad advice. Just like the choice in your surgeon and your teacher, you need to find the best. The best can save lives, the best can provide inspiration, and in this mundane world of investment management, the best can earn better returns and take less risks. Look at the returns of these university endowments. And as this chart demonstrates, while not without its challenges in 2008, these investment teams have produced years of outperformance. And the reason is simple. It's because they are exclusively focused on the return of their client. They are experts in identifying investment talent and assembling them, and they follow a disciplined investment process. In short, these teams bring the right kind of advice and the right kind of service for their client. And the question for this group, as you think about the performance of your own portfolios and the portfolios for which you are responsible, is how you can access teams like this who have no conflicts of interest, who are focused on your interest, and provide investment service over a continual period. Next, so the second observation is that you don't have to accept average results. The third observation is that buying power makes a difference. Look at this. This is the return of the Carnegie Foundation, following this investment style. It shows what can happen with a talented investment team that operates at scale, singularly focused on a single client. It shows that size makes a difference, not just in reduced fees, but in better performance. I don't need to actually walk through the results here, but if you see that mountain at the end is where you want to be, and that's after disgorging almost $2 billion in distributions. So what are the observations? The right kind of team with the right kind of advice, operating at scale, produces power and influence. That's not a bad thing, and this is what can happen. So by acting together, this group too can develop the same kind of clout in the investment world. Observation on 2008, number 4, which is be prudent about socially responsible investment, also known as SRI. This is a topic on which there has been a lot of discussion. Investing is difficult, even without the constraint, even when the only constraint is trying to optimize your returns. And while everyone is unified around the concept of investing only with those of character and values, the actual implementation of SRI has generated a lot of discussion, because there's no great consensus on what is meant, and there's a considerable debate on the results, except, of course, from those that are trying to peddle a product. Most scholars and many practitioners will observe that SRI is ambiguous, sometimes based on unreliable data streams, and clearly limits options. Most agree that SRI can hurt performance when applied as a negative screen, but has potential when applied as a positive one. So as this group wrestles with the concept of how to apply social responsible investing, SRI, to the management of your own portfolios, I put out 4 options for you to consider and think about. And then in our breakout session later, maybe we can get into them in a little more detail. The first is follow the lead of some of the world's great investors, like a Harvard, a Yale, a Notre Dame, a BC, and jointly create a fund that sets a strategic asset allocation, broadly invests across asset classes, and sources the world's best investment managers. Use a primary screen of character and competence and a primary objective of investment returns. This portfolio, like the Carnegie Corporation, would be unified around the objective of serving a client without conflict and optimizing the return and risk profile. Option A. Alternative B. Follow an investment style that optimizes portfolio returns, similar to those in Portfolio A, but also incorporates, where possible, a positive screen on Catholic values as one factor in the decision process. Here, while there's some question that will remain on the accuracy and the detail of the filters, the portfolio could incorporate a positive screen, and all things being equal, could reward those managers whose character most closely aligns with those of the church. Alternative C. Dedicate a portion of the portfolio to pursue mission-directed activities. Think of the mission, think of the screens, as an asset class. Invest thoughtfully with managers managers of character, just like the portfolios in A and B, with a major corpus of the portfolio, but isolate a target portion of the funds to mission-related activity, where the returns can have a dual measure. In this manner, the target is clear, serve as the fiduciary for your constituents for the body of the portfolio, and target a portion to help improve the lives around you. And then alternative 4. For those interested solely in using the funds under management in pursuit of the interest in following the screens, craft the portfolio together to actually focus on this as a mission. These 4 portfolios offer the opportunity to invest together as a group, but they offer different risk and return profiles. It may make sense for different organizations at different times. So let's summarize a little bit and then draw the implementation observations. We started by talking about our role as a fiduciary, carefully stewarding our clients' assets during a period of economic and market activity, mindful of the painful lessons of 2008, recognizing that the responsibility of investing is continual because there is no timeout and no sidelines. We commented on 4 important lessons from 2008. A thoughtful strategy allocates across assets and matches assets and liabilities by allocating across time. Rely on the advice of an investment team which is dedicated in its focus, expert in identifying investment talent, and can follow a disciplined investment process. Get the benefits of scale to afford the best investment talent and demonstrate clout in the investment world. That was lesson number 3. And number 4, be prudent about your approach to SRI. In short, this all creates the basis for the case for collaboration. Because the benefits are clear. By acting together, this group can create the scale which makes a difference, accessing better talent at lower cost with improved returns with less risk. Now, pathway forward. This group is uniquely positioned to focus on identifying the areas of collaboration. The reaction normally to issues of collaboration is I'm different, I'm unique. Everything has to be customized for my own individual issue. What this group can do is identify the areas on which there can be collaboration, clout can result, and investment results can improve. The first relates in the definition of what I call here investment architecture. Here is the scale across time. A pool focused on short-term assets, a pool focused on the interim cushion, and a pool focused on aspirations. This group can help identify the elements of what really that means. The second relates to the investment approach. I've suggested here an approach that resembles BC or Notre Dame or Harvard or Yale, some of the world's most sophisticated investment teams, which is a disciplined investment style, setting a strategic asset allocation, scanning the world for the best managers, assembling them intelligently, rebalancing over time. This group can set the strategy. Here's the way we would like to invest. The third is the investment guidelines. SRI and the filters means different things to different people. Some of the data streams are reliable, some are more difficult to implement. This group can help establish what that principle means, how it should be applied to a portfolio, and what are the most reasonably and prudent ways of taking this difficult investment world and doing the best you can. And finally, can create an implementation protocol, which is identifying the funds in which there can be commingling of assets, where you're an investor in a fund with your own interests remaining segregated, but where you can get the benefits of scale and the importance of cloud. So this group has come together on so many important issues, and as Patrick outlined, the potential impact on procurement. The same is true in the investment world. Because if you take the power of these assets when working in a collaborative fashion, you can become the envy of the investment world in developing clout, power, and influence, and the net result will be better results at lower cost with lower risk. And you all know how you can invest those results in your own communities.